All right, chapter 4 homework. I am in Connect. I'm going to do the whole thing the way I've been doing it. Um, if that's not helpful to you guys, let me know. Okay, so this is the first question. And in this question, it's asking us to calculate the net sales price or the net purchase price, we should say, or either one, just the net invoice price. So if our merchandise is 8,000 and the terms are 2% within 10 days, remember that's not 2 divided by 10, it is 2% within the 10 days. The following one is 1% within 15 days. Otherwise, going back to item A, you have to pay the full amount in 60 days. Anything between day 11 and day 60. So if I'm only going to pay 98% of 8,000, then the invoice price would be for A, I'm getting 7,000, sorry, I'm getting 7,840. We could check my answer. And we got it right. I'll let you do the rest. All right, moving on to question 2. So in this question, we're recording purchases, returns, and allowances. So this question is dealing with transactions between the merchandiser, us, and the vendor, where we're purchasing Barbie dolls from Mattel, right? And just as a reminder, every single transaction, whether we're talking about the net price, gross price, invoice price, shipping, returns, discounts, everything is always going to touch at least one time the merchandise inventory account. Okay, so we have various scenarios. Purchased 1,050 units of product at a cost of $16 per unit. The terms of the sale are we get a 4% discount if we pay within 10 days. Otherwise, we pay the full amount. So the journal entry to record at least November 5th would be merchandise inventory, I believe. Or maybe just inventory. There we go, merchandise inventory. And accounts payable. And the amount would be the gross amount. That would be 1,050 units times $16 per unit. Boom, magic. 16,800. I'm going to check this answer. Nice. Answer is incomplete only because I haven't done the next two. So look, we're going to return 50 defective units. Okay, I will leave you to that. The only thing that I will remind you is that on November 15th, if we're paying within the discount period, right, we're going to take advantage of the discount, but we do also have to take into account the returns, right? So 16,800 less the returns, then we'll take the discount. Moving on. Question 3. Okay, so in this question, we're recording sales and returns with a credit terms. Okay, so prepare journal entries to record each of the following. So we're selling merchandise, right? So again, this transaction is we are the merchandiser and we're selling to customers like you and I. So on April 1st, we sold $7,000 with credit terms, net 30. So they don't even get a discount. The cost of the merchandise was 4,200. Okay, when we sell using a perpetual inventory system, at the time of the sale, we make 2 journal entries. The first journal entry is to record revenue, and then the second journal entry is to record the cost of goods sold and the reduction of our inventory. On April 4th, the customer is going to return $780 worth of merchandise. And remember, unlike when we were dealing with transactions between the vendor and the merchandiser, we dealt with returns as impacting directly the inventory account. However, on the sales side, we are going to create a contra sales account called sales returns and allowances. And if the customer is returning goods and services, we have to do two things. We not only have to unwind the sales transaction from April 1st, but then we also have to unwind the cost of goods sold from April 1st. So the April 4th is going to also require two journal entries. I will leave you to that. And then we're going to sell more inventory on credit terms. And again, at the time of the sale, we don't account for the discount. We only account for the discount if the customer pays within the discount period. And if the customer does take advantage of it, again, we debit the sales discount contra sales account. And so I believe I'm going to leave you to this question as well. Question 4. The company's ledger on July 31st, its fiscal year end, shows merchandise inventory 39,300 before accounting for any shrinkage. Anyway, a physical count of its July 31st year end discloses that the cost of the merchandise inventory still available is 38,000. So again, we're saying our books and records show 39,300, but our physical count shows 3,800. So I think we have to lower the accounting records to reflect the physical. And we covered this in the lectures, right? Again, it's treated as cost of goods sold. So it would be a debit to cost of goods sold and a credit to merchandise inventory. Question 5. So recording purchases, returns, and purchase allowance. Boy, this is a lot, very much like a question we've already seen. So we're going to purchase on April 2nd, $7,000 of merchandise from Lion Company with credit terms. Okay. The invoice is freight on board, shipping point, meaning the buyer takes ownership of the goods and services at the time immediately once it leaves the seller's place of business. And so usually if that's the case, then the buyer, us, has to pay for the shipping. And so you'll see on April 3rd, we paid cash of $390 for the shipping charges. And again, remember, when we're dealing with transactions between the merchandiser and the vendors where we're acquiring inventory, everything hits the inventory account. So shipping fees are an additional cost of inventory. And then keep in mind that when we're provided a discount, we're only provided the discount on the physical goods, right? Because it's a separate company that's doing the shipping, and that separate company is like, well, fuck, we didn't provide you, we didn't agree to this. If you pay us within some period of time, we're going to give you a discount. Like, you paid cash, there's no change in that. So if there's a discount, it's applied to the vendor's cost of goods that we acquired. And then again, remember, when we're taking advantage of the discounts and paying for inventory, we always want to account for the fact that if we returned anything, we have to adjust the inventory account first for those returns. Then we can figure out what the proper discount would be. Going to question 6. I think I'm just going to keep going because this is very much similar to the previous question. Okay, separate issue, closing entries. All right, so again, this is review. We are only going to close the temporary accounts, right? So anything that hits the income statement, and then usually dividends. So retained earnings, that's a permanent account. Dividends, that is something that we're going to close out. and we covered that in chapter 3. Sales we're going to close out, and then sales discounts, sales returns. Those are two new accounts that we do want to close out. And again, those are contra sales accounts, so they typically have a debit balance. And so to close out sales discounts and sales returns, it really is going to be okay. So if I just look at the sales returns and allowance and I ignore all the other accounts, the way that we would close out sales discounts and sales returns, again, it would be sales discount. In order to close that out, if it has a $4,700 debit balance, sorry, let me see. If it already has a 4,700 debit balance, then I would credit sales discounts by 4,700. Then I would discount or credit, sorry, sales returns 4,700. And then I would debit income summary. And what is that? That is 9,400, right? And again, that is just an example of the sales discounts and sales returns. But then after we close out all of the revenue and expense accounts to the income summary, we then figure out what the ending balance is to the income summary. Most likely it's going to be a credit balance because there's income. So then we would close out income summary by debiting income summary, and then we would credit retained earnings. Moving on. Question 8, same deal. We're closing out accounts. So my suggestion would be, okay, if it helps, I would just start drawing out T accounts. Just so that you can kind of keep track of what accounts are originally debits and what accounts are originally credits. Why did things have to be so complicated? Sorry about that. So anyway, my suggestion would be to maybe list out all of the T accounts and then show the ending balance of each one of these accounts. For instance, dividends is an equity account. However, it has the effect of lowering equity. Therefore, it typically has a debit balance. Sales is obviously an equity account. It increases equity, and therefore it typically has a credit balance. And I noticed a lot of you actually were suggesting that dealer is a good way of actually, it would help if I knew how to spell dealer. So that's obviously not how you spell dealer, right? Dividends, expenses, assets typically have debit balances. Liabilities typically have credit balances. Equity, credit balances. Revenue, credit balances. Maybe you could even spell it like this. I don't know. What is it? I guess I don't know what I'm talking about. See, this isn't the way that I remember it. Dividends, expenses, assets typically have debit balances. Liabilities and revenues typically have credit balances. Maybe there is no R there. Maybe it's just dealer. But something tells me that's wrong. But anyway, the point is that hopefully you have a method to remember debits and credits and which one of these accounts which account balance we show left or right side for each one of these. And then once you have a good vision of that, then I think the closing entries are a little bit easier to manage, in my opinion. Okay, so, and again, there's 4 types of entries. The first one would be to close out revenue to income summary. The second one would probably be to close out expenses and now discounts and returns to income summary. The third one would probably be close out income summary to retained earnings. And then the last one would probably be dividends to retained earnings. That was for more or less review of the previous chapter. Okay, so, all right, question 9. Question 9 is now moving to creating the financial statements for a merchandise company. And this specific question is just asking us to compute net sales using the multi-step income statement. And so net sales is really just gross sales minus sales discounts, sales returns, right? Sales salary expense, that's going to go way down in the operating expenses, probably sales and marketing operating expenses. So that wouldn't be included in this question. It's a trick. Question 10 is again asking us to create an income statement. And again, it's a multi-stepped income statement. And so what I would do to tackle this question would be to pull, if you need to, pull up the PowerPoint slide that shows the nice layout of the multi-step income statement. But just for very quick review, the multi-step income statement, right, it's going to have the sales section. And we just went through that in a previous question where we're going to have gross sales and then less discounts and returns to get net sales. Then once we have net sales, we would subtract cost of goods sold, and that would give us our gross profit. And then once we have our gross profit, we would then subtract from that the operating expenses. And typically there's at least sales and marketing, there could be general administrative expenses, and then there could be a third category, which is research and development. But you would just want to go back through this list and identify, right, the various types of expenses, operating expenses, that is. You know, insurance expense, I would probably include that in the administrative section, way down at the bottom, right? Somewhere down here. And then I would probably include sales staff and salaries expense somewhere in the selling expenses. Question 11, prepare a classified balance sheet. Again, I would go look at the PowerPoint slides, but in essence, this question is asking us to break out the assets and the liabilities between our current assets and long-term assets and current liabilities and long-term liabilities. And just a reminder, current assets, I apologize, are all the assets that we intend to convert to cash or use within 1 year. So like the first one, buildings, that's clearly not a current asset. Accounts receivable, that clearly is a current asset. And so we would just have to like identify the assets first and then whether they are short-term and long-term. And I will leave you guys to that. And then like all the other previous homework of questions, I think once you've finally had enough of the class and the chapter, you then got to do the most involved question. I personally love these questions at the end because they basically tie everything together. It's really good stuff. And I'm going to leave you to this. I think we've covered most of this for the most part. Schedule of receivables, maybe schedule of payables. Maybe we haven't done those. Maybe we haven't done them as well as we could have. But a schedule of receivables is just going to be a recitation of all of the specific accounts who owe us money. Okay, and so in this particular example, we have Wilson, Hall, Walker, and Brown for a total of $11,200. The only thing that shows up in the balance sheet of the asset section would be the total, right? We're not going to list out the receivables of all of our accounts, but we'll list out the total. And then deep in the accounting system will be the backup or schedules of receivables and schedules of payables. And so on that note, I think I will leave you to this week's homework. I hope you guys found this to be helpful. Feedback's always good. Hope the videos are working, and I will talk to you soon.